In South Korea, 1.2 million accounts have been hit with margin calls. People have lost everything and are now in debt. This all happened because of a lesson called leverage, and this disaster struck the stock market that was considered the best performing in the world for 2 years in a row, the South Korean stock market, KOSPI. Today, out of every 30 investors, one has been hit with a margin call, and over 300,000 accounts have been completely closed. What's more, this all happened right in the middle of the market, with South Korea's major blue chip stocks like Samsung, SK Hynix, and others. To be clear, everything that occurred, the stocks I mentioned, Samsung and SK Hynix, weren't the problem. Investors weren't wrong. Their judgment was correct. These stocks actually generate profits and have real fundamentals. The only thing that went wrong was the estimation of leverage. Because the problem that happened, whether it's South Korean stocks spiking and then plunging sharply, it all came from a single financial product called the One Stock Leverage ETF. In this episode, I have to say, you really should watch it, and we'll learn something about leverage, that if you're not truly ready, just don't do it yet. It's definitely worth your time to watch. This video is sponsored by Zontes motorcycles. Super cool. And it's really easy to support the Try Money Monster channel. Just hit like, share, drop a comment to chat with us. And have you subscribed yet? Don't forget to hit subscribe for us too. And if anyone wants to support the Try Money Monster channel so we can keep making great independent content like this for a long time, you can become a member too. Thank you. So in this clip, let's start by pulling up the KOSPI chart, which is South Korea's stock index. You'll see that, honestly, before this, it wasn't all that exciting. But then in 2025, the KOSPI index just shot up, like climbing a cliff, reaching an all-time high. And by June 2026, it had surged from 2025 by as much as 250%. At this point, the South Korean stock market was performing better than it had in the past 4 decades, outshining everyone else in the world. It took first place, winning the top spot outright. And not only that, it held the #1 spot for 2 straight years with world-leading returns. So anyone who invested in the South Korean market 18 months prior were smiling, because at that time, the KOSPI was the world's strongest bull market. But if you happen to come in later than those 18 months ago, you're probably holding your head in your hands right now. Because today, South Korea's KOSPI market has crashed and turned into the harshest bear market in the world. If you look at the KOSPI chart again, you'll see that since it hit its all-time high in June until now, it's dropped about 23% in just a short time. This is based on the chart I looked at on July 21st, 2026. And when I say it's a brutal bear market, it's not just about how deep or fast it's fallen. It also messes with investors' emotions. It keeps going up and down with extremely high volatility. Let's look at the daily movement chart of the KOSPI index. I got this from Bloomberg. Now let's take a look together. This is the national stock market, right? Stocks really shouldn't be swinging this wildly, should they? If it swings more than 5%, it's highly volatile. Now look at this chart. Editor, highlight these. This dashed line here is the upper line, representing 5%. The lower is -5%. And these orange bars here represent the price. You can see that the KOSPI index goes above 5%. It drops below 5% too. That's actually pretty normal. It happens almost every day. On a daily basis, the volatility of the KOSPI market can swing up 10 or down 10%. It's totally normal. According to data from the Financial Times, the South Korean KOSPI stock market has been so volatile that just this year, the government has had to halt trading a total of 37 times. And that's just in a little over half a year. Compared to last year, there were only 3 trading halts. Hearing this, some people might think, wow, does this mean the Korean market is like a gambling den with people betting recklessly? Is it that there's no real fundamentals or anything like that? Well, that's not entirely true. It's partly wrong and partly right. But first, let me point out that the companies at the center of all this volatility, they're the giant blue chip stocks of South Korea, Samsung and SK Hynix. Yes, they're #1. These 2 companies together control the major supply of memory chips for the entire world, specifically high bandwidth memory chips, which are actually used as hardware in AI. And if you've watched the episode about expensive chips on the Sai Money Monster Teal, I mentioned, right, that in 2024, there will be a period when datasets are booming like crazy. So the data center crowd is out there buying up chips and competing to buy chips from South Korea, basically from Samsung and SK Hynix. And most importantly, they're offering prices 10 times higher than what they used to sell to washing machine companies, making toys, making computers, stuff like that, and selling them to data centers. With prices 10 times better, that's why both Samsung and SK Hynix saw their revenue and profits increase dramatically. And that's what led to what we call profit. So the profits that Samsung and SK Hynix made are absolutely real. This caused Samsung's operating profit in 2026 to increase by 756% year on year compared to last year, reaching 57.2 trillion won. As for SK Hynix, their revenue increased by 198%, and their operating profit soared by as much as 400%. And if we take a look, you can see that the prices have gone up a lot. This is a graph from the Financial Times showing that both stocks surged dramatically during their uptrend. But as I mentioned earlier, once they hit their all-time highs, they also dropped sharply. So why did they drop so much? There are both external and internal factors at play. The external factor is the AI boom, right? Right now, data centers are also hitting a snag. The ones who buy a lot of chips from Samsung and SK Hynix are data centers, right? The ones who pay top dollar. But today, if data centers can't keep back, the external factor is that customers from outside aren't booming like before, so that part is gone. As for the internal factors that cause this to happen, this one's complicated because it's a mix of three things combined. The first point is the extreme concentration of the index, which, as I've mentioned several times, is concentrated in Samsung and SK Hynix. Just these two stocks together now make up almost 56% of the KOSPI index. This 56% came about because their prices surged dramatically, especially over the past 18 months or so. Even now, these two stocks together still account for about 40% of the KOSPI index, which is still a lot. But because it's so highly concentrated, and as their prices keep rising, it creates FOMO and attracts even more investors. And when people put all their money into these, concentrated simply means it's not spread out. It doesn't diversify the risk. This is where the risk comes in. In the second place, it's the unique trading culture of South Korean retail investors who are more than willing to embrace a significant amount of financial risk, and their sheer numbers are quite substantial as well. You could say they have real power as retail investors. The third point is like sprinkling gunpowder on top. That is leverage, or aggressive use of borrowed money. Now, let's explain these 3 points. First, the intense concentration in the index. Let's move on from this one since we've already explained that it makes up about 56% of the index. Let's go to the second point. Why are retail investors in South Korea able to take on so much risk? In the South Korean market, there are even studies showing that this market is nicknamed the Squid Game market. This refers to ordinary people who are extremely willing to take on high risks because they want to get rich overnight. In the game, those who take such high risks have about the same chance of surviving as in Squid Game itself. Everyone goes in and maybe only one person makes it out alive, something like that. You might ask, why is that? Because South Korea is a country with a lot of pressure. There are extremely high expectations placed on people. You need to be good looking to get hired. To marry, you have to be rich and own a house. Honestly, 30-somethings in South Korea are just like people here. Not many people in their 30s can actually afford a home. South Korea's economic miracle has ended, and the economy is not doing well. For a deeper look, check out my video called The Expired Miracle of South Korea. Go check out. And what's happening now is making the standard path, the one we've all been taught since we were kids, like study hard, get a good job so you can earn a good salary at a good company, it just doesn't work anymore. It can't really get them to the point where owning a home, being wealthy, and having status feels impossible. You can't even save for cosmetic surgery. And more importantly, if you want to just put your salary into a savings account hoping to get rich, it's not going to happen. So when the usual path we were taught, like do this and it'll be good, just doesn't give any returns, and the returns are basically close to zero, it's actually a bad path. It's a path that doesn't get me any recognition in life at all. It's a path that takes me further away from being rich. So that's why the high-risk path doesn't really seem so bad at all. Sounds familiar, right? It's like saying, hey, Thai people buy lottery tickets. Sure, it's hard to win, but if you don't buy, there's no chance at all, a chance to win it all. Now you get it? Why Korean retail investors are able to handle so much risk? Because they can tolerate high risk. Because life is tough. And I have to say, Koreans have a really intense investment culture. They're really skilled, which is why there's actually a nickname for retail investors in Korea. Locally, they call themselves the Ant Army because they have a huge number of people. There's so many of them that they have enough power and influence to beat the big players or even create trends. They even create their own trends. South Korea has about 51 million people and 14 million are investors, roughly 30% of the total. So these 14 million investors in South Korea, that's why I said they have power. It's true. They account for about half, or roughly 50% of the trading volume in the South Korean market. Meanwhile, institutional investors and big players, like pension funds and such, only account for about 18% of the trading power in the South Korean market. And foreign investors' money in the South Korean market makes up just about 3%, just 10%, that's all. And what has happened over the past 18 months is that institutional investors and foreign investors have pulled about $95 billion out of the South Korean market. But the army of retail investors in South Korea, no care. Right. Institutions pull out, foreigners pull out, but I'll buy in. That's why money from Korean Ant Army retail investors has flowed into the market, totaling $80 billion. This name isn't just for show. It's truly powerful. They can really set their own trends. There's a famous example of this back in 2012. Take a look at this chart. At first glance, it might not look familiar, but once I finish telling the story, you'll totally get it, because this is the stock chart of a company called DI Corp, which manufactures semiconductor equipment. So DI Corp stock went by 800% within 3 months, causing the company's value to increase from $38 million to $334 million. And it wasn't because sales, profits, and fundamentals hadn't actually improved at all, or any sensational news being released. None of that happened. All this increase was due to the power of the Ant Army manipulating the stock price. Because Psy, the singer of Gangnam Style, is the son of this company. And it was because Appa Gangnam Style was so insanely popular. That's it. Okay, now you understand points 1 and 2, right? So the first point is that the stock was extremely concentrated. It was a heavy, really heavy weight, 56% of the market. Wow. And the second point is that the Ant Army, or retail investors, in South Korea can tolerate a very high level of risk. And they also have both numbers and a lot of power. So let's move on to the third point, which is about the explosive power of leverage. It's like sprinkling gunpowder into this mix. That's what happened. So in 2025, some major regulatory approvals took place. Then in 2026, South Korean securities companies launched 16 different One Stock Leverage ETFs, specifically linked to the performance of Samsung and SK Hynix. Each fund promised that individual retail investors could get daily returns that were exactly double the reference stock price. Just as an FYI, as I mentioned earlier, the KOSPI market is a highly volatile and unpredictable market. Stocks can go up by 8 and down by -9 as a normal occurrence, but that still might not be risky enough for what the retail investors, the so-called Ant Army, are looking for. They might want something even more exciting and intense than this, and a product called the One Stock Leverage ETF probably hits the spot for the Ant Army. This fiery leverage has caused the ETF to balloon to as much as $13 billion in just 9 months. According to Bloomberg, the ETFs that have emerged in Korea are ETFs that are based on leverage on a single stock, the biggest ever. So now let's talk about how this leverage ETF actually works. A single stock, something like that. Okay, let me pull up this chart with 4 sections to make it easy to understand, but let me explain. Whether it's easy or not is another story. Normally, if you trade stocks, let's say you buy a stock and it loses 10%, you just acknowledge it. Like, hey, my stock is down. You've already lost 10% of your money, and that's it. Nothing else you need to do. Everything ends right there in that first blue box, nothing more. But with leverage, it doesn't work like that, because leveraged ETFs, they promise to give retail investors double the daily return. So what leverage has to do next is shown in the yellow box, which involves swaps, derivatives, futures, or whatever else. They can either buy or rent them. They have to handle the second yellow box so that every day they need to do what's in the red box, which is rebalancing or resetting the portfolio daily to ensure the return ratio matches what's in the box. The green box, meaning tomorrow, it still has to be 2 times as promised. The problem with this whole setup, all of it really, the reason this happens is in the red box, the daily portfolio adjustment. Because when stocks go up, the ETF has to adjust its risk exposure. They have to buy more stocks. Otherwise, tomorrow it won't be 2 times. The green box won't be effective. Likewise, on the flip side, when stocks go down, they have to sell stocks to reduce risk. That means this ETF has to sell more stocks on days when the market drops so that the next day, the green box will still be the same, which is 2 times. To put it simply, what does that mean? It means that this fund has to buy more stocks on days when stock prices go up, and it will have to make things worse by selling off stocks on days when prices drop. And it has to do this every single day at the market close, but without any opinions or analysis whatsoever about whether buying or selling is good, because all of this has to be done strictly according to the system. As I mentioned, in the South Korean market, these 2 stocks, Samsung and SK Hynix, make up 56% of the market, which means the proportion trading from the fund has a direct impact on stock prices and the index. So if things are good, this ETF will amplify it, making them seem even better. And if things are bad, this ETF does the same thing. It amplifies the trend, making them seem even worse, as you can see. Do you see the picture? Like I said, right now AI is booming, but data centers aren't doing so well. They might not have the money to buy chips at 10 times the price like they used to, did back in 2024. And when external factors come into play, like when customers just stop buying, the price drops. That's why on July 15th, even though SK Hynix stock had just hit an all-time high, it dropped, a double-digit drop, really significant. As of the day I'm writing this, July 21st, SK Hynix has already fallen and is down 36%. Goldman Sachs even assessed that this rate of decline. SK Hynix forced the company to sell $5 billion in shares. When was this? Check the 4 boxes. It happened during the red box period, right? To prepare for the next day, the green box would be double again, just like before, to balance the portfolio. So what was the result? It amplified the drop, causing SK Hynix to fall harder and faster. This triggered South Korean retail investors' margin calls all at once, affecting about 2 million accounts. Now, some might want an explanation. What is a margin call, right? Simply put, it's like when you put down collateral, right? And when you get a margin call, it's when the stock price drops a lot. And then the broker might call or send you a message saying your collateral isn't enough anymore. Please add more funds, otherwise we'll have to close your portfolio, something like that. Closing the portfolio means forced selling. And because the price dropped so quickly, to the point where the broker couldn't call or they couldn't call in time, and even if they messaged, it might be missed. So everyone was forced to sell. During that time, out of 1.2 million accounts, about 320 to 60,000 were liquidated. Not only were they forced to sell and had their portfolios wiped out, for some people, they were forced to sell when the price dropped, right? So when they sold, the money they got wasn't enough to pay back the broker. Their portfolios were wiped out and they ended up in debt. That's what happened. And during that time, the deposits in retail investors' securities accounts all across South Korea dropped by almost 30 trillion won, falling back to the lowest level since last February. Now, the government of South Korea had to step in and set restrictions, like requiring investors to put up a certain amount of collateral before they can invest in ETFs. And anyone who wants to invest in leveraged ETFs has to take a course first. It's kind of like they opened a casino and then set rules. Players must take a class and get certified to join. But anyway, this is a real lesson that stock prices don't necessarily reflect the fundamentals of a stock. When we see stock prices going up a lot, actually there are indicators indicators that we can look at in many ways. There's so many indicators we have to take a moment to look and see if the stock is rising because its fundamentals are good, because it's selling more products, because it's making more profit, whether it's consistent long-term income, stable income, or just a short-term gain or income for some other reason. Or is it rising because of some fintech product in the market, or is there leverage involved, or is that why it's gone up this much? Don't let the market fool you, especially when a stock price rises due to leverage. Look, you can jump into the leveraged market and try it out. Start with a small amount, but only use money you can afford to lose, especially if you lack experience. Leverage has perks. If used right, it can hedge risk. But if you don't know how to use it, I really want you to remember that when a stock price goes up a lot because of leverage can't make any stock or company be a good company. It can't make that company better at selling products. It can't make the company's fundamentals any better or turn all the hype and excitement into reality. Whether it's during the real estate boom, whether it's the internet era or AI, it doesn't become real because of leverage. But leverage can actually make one thing happen, especially for people who aren't experienced or knowledgeable enough. Leverage can make FOMO investors go broke and end up in debt.